Welcome to this explainer. So, Choice Properties REIT, safe haven or ticking debt bomb? Let's find out.
A 5% yield anchored by Canada's biggest grocer, honestly, it kind of sounds too good to be true.
This isn't some small operation. They're an absolute behemoth dominating Canadian retail and mixed-use real estate.
We're talking massive scale here, pulling in a steadily growing 1.41 billion Canadian dollars in revenue. Their moat is undeniable. Think ironclad Loblaw leases, stable grocery demand, and over $17 billion in assets. But hey, massive scale comes at a hefty price. Let's flip over to the balance sheet. Yikes, $6.8 billion in total debt. Suddenly, that stable fortress is looking pretty stretched, right? With debt to equity blowing past 276%, rising interest rates make this leverage a literal financial hazard. To spot the real danger, we gotta look at AFFO, the actual cash left over after property maintenance. Check out this wild disconnect. They only generate 47 cents, but they're paying out 78 cents. That is an unsustainable 166% payout ratio. They literally need debt just to fund your dividend. Red flags everywhere, guys. Weak cash coverage, scary leverage, and heavy reliance on just one major tenant. We have to weigh those super stable grocery tenants against their incredibly aggressive debt-fueled development strategies.
So, with risks this high, does the current stock price actually give us a deep value deal?
Unfortunately, no. You're actually paying a really steep 24% premium over the true net asset value. The market is blindly pricing in stability here, leaving us with almost zero downside protection. If our goal is a solid 9% annual return over the long haul, where should we enter? The price would actually need to drop to $13.60 for an adequate safety margin. Because of that crippling leverage and weak cash flow, our final verdict is a highly cautious hold. I'll leave you with this. In a world of rising rates, is a 5% yield worth massive debt?